very good evening. You're watching The Money Show on ET Now's Rise with India Primetime segment with me, Mubina Kapasi. It's an action-packed day on The Money Show, but obviously, because it's been an action-packed day on the Lal Street as well, if you guys have tuned in at 9:15 a.m., you will notice that there was this period where the markets really didn't do anything because that's the state of affairs we were in. Markets slumped, hit lower circuit. Trading was paused for 45 minutes and then resumed trading with almost a 1,000-point upswing. This is the sort of volatility we've seen in the equity markets. But largely, if you look at the week gone by, worst week since 2008. In 2008, of course, was the global financial crisis. Nifty Bank posted its worst week since 2009. IT was the same. Realty since November 2016. PSU banks, in fact, that sector hit a record low yesterday before recovering today. But nevertheless, week to week, again, a really bad week for the PSU banking index. The small cap index as well was hammered out of shape. And for the Nifty, we're just at about 9,400 odd, 500 odd. We did try to attempt to come back above 10,000. But yes, all in all, this has been the worst week for the markets all the way since the global financial crisis. Now, obviously, if I'm going to compare the week to the global financial crisis, you guys must be wondering what exactly does that mean for my mutual funds? Well, that's exactly what we are going to be talking about. I'm joined by a very special guest, Mr. A. Balasubramanian of ABSL AMC. Mr. Bala, thank you for joining us on The Money Show. It's a very special episode indeed, and I think people want to hear from voices like you who literally manage so many crores of rupees, right? And what are you going to do? But before I come to you and, kickstart our market chatter, kickstart our chatter on mutual funds, I want to just go across to my colleague Jayesh Khilnani. He's standing by with some very interesting data of what we exactly saw on the Nifty 50 and have we seen it in the past. Jayesh?
One of the biggest that I have seen, at least, in quite some time. But what we did was map out the entire, history or last 10 to 12 years that the swing has been from the high to the low of the Nifty. Let me start off with 2008, and the benchmark that we have set is the difference between the high and the low has to be about 600 points that we have looked at. The global financial crisis 2008, 21st Jan and 22nd Jan, these are the 2 days that we saw more than 600 points swing. In fact, these 2 days resulted in a swing of more than 1,500 points between the high and the low. Then we forward to 2009 when we had the UPA 2 come back into power. That is when we saw a big surge in the market as well. That was in fact the only upper circuit that I have at least seen in my lifetime that the market in fact hit. Then 2012, a rather bizarre incident happened. One of the traders had punched in an erroneous trade, and because of that we had a flash crash in the market, but we did manage to recover from the lowest point of the day. From 2012 till 2019, there was almost a period of lull, though the market moved from strength to strength, but 2019 is where we saw more than 600 point swing on the Nifty between the high and the low, and that was 20th September when the finance minister announced the corporate rate tax cut. And today we have had a massive recovery in the market from a lower circuit of 10% to almost 5% in the green. That is almost equivalent to 1,600 points of recovery that the Nifty has staged. So this is the biggest recovery that the market has in fact seen in its lifetime.
Okay, all right, Jayesh, thanks a lot for that. So I think, Mr. Bala, as the data suggested, this was a bad day. It turned out to be a great day. But again, this is not something that we've not seen in the past. We have seen such wild swings in the past as well. And, we've been drawing parallels to what happened in 2008. Are we looking at that sort of a situation? I mean, are the Indian equity markets really in that sort of a situation?
I think you mentioned about that we are not seen in the past. Of course, it's right that the one which we saw the last in 2008 crisis when Lehman Brothers collapsed in the global market, we saw a huge swing in the market, and then there was a time where we were all hoping that it will hit the down circuit that we saw once. Then second, before that we saw once in Vajpayee government collapsed and the market hit the lower circuit. Then of course it got recovered. I think today's swing is actually pretty big. I think almost about 3,000 points at the downside, then upside about 1,500 points, effectively about 5,000 points swing. It's pretty large movement, and now if it has just happened in a single day, it would have been fine, but it has been falling continuously for the last 3 days. So that's such a sharp fall, close to about 20-25% in a matter of about 15 days. It's just not happened only in India. I think the global financial market falling, it's something which is unique. And of course, obviously, market is correcting once and for all. The expectation of growth actually is getting reduced as it used to happen in the past, thanks to the coronavirus, as well as the sharp fall that we have seen in oil in the weekend. While it of course benefit in general in India, but having said that, I think the oil price fall naturally it takes the income in the respective countries. I think the multiple factors created a huge amount of panic. I think the one-time sell-off coming in created a huge volatility in the market, and luckily, of course, market stabilized today. But for that, I think it would have definitely created more panic.
Okay. You know, we always say we live in the best of times and we live in the worst of times. We're living in the worst of times because of the factors you mentioned. But best of times maybe to buy in as well. And, you know, on the Money Show today, we're also joined by Nikunj Dalmia, ET Now's managing editor as well. So, Nikunj, thank you as well for taking out time. So, yeah, Nikunj, you know, all morning we've been talking to a lot of market experts. We've been talking to them about whether one should panic, whether one should buy in, use this as a mega sale, or we've been saying a kid in a candy shop, right? Is that really what market experts are saying, that you should say that you're a kid in a candy shop and pick out?
Let me do what Bala has not done, which is based on experience, technicals, on the record and off the record conversations. My understanding of valuations and what I've learned over the years is that when you see moments like this, and when you see what could be called as a financial Armageddon, you need to be a buyer. It pays to be, it has paid and it will pay to buy fear in the stock market. I think that's a simple analysis which we need to bring out. 2008 was a scary fall. It was a man-made crisis. It was a crisis which in a sense shook the system. So to draw a parallel purely based on price action that this is as bad as 2008, I think may not be correct. But the bottom line here is that money is made not by looking at past returns, but by preempting future growth. I know, Bala, I'm doing the marketing for you right now here, but that's my firm belief that if you panic now, it's too late to panic. If you wanted to panic, you should have panicked, let's say, 2 months ago.
Yeah, okay, true. Mutual fund perspective, obviously, and I'm sure, Mr. Bala, you as well have been getting a lot of calls from a lot of your big investors. What's the one question they've been asking you? Should I redeem? Should I decrease my SIP? Should I pause my SIP?
See, one of the things that fundamentally have changed with respect to the mutual fund investors as well as the distributors, and at large, the people who have been following the mutual fund industry, which has remained more or less at what time one should buy and how long one should buy, for what purpose they should buy, and whether we should buy to the SIP or the lump sum. So that has been a constant question comes whenever we see a fall coming in. But of course, during this period when we saw actually continuous fall in the market, naturally for anybody, when their value of course not getting depleted almost on a daily basis, but they know the fact that it's not happening only in India, it's happening for the global market as well. But still, when you see the NAV falling, naturally you start getting worried. So then you start debating and discussing what should be done. Should I redeem? Should I stay invested? Or should I continue? But I think the one interesting thing is, when as a mutual fund industry, as you mentioned about, this kind of fall is not going to come back again and again. I think they're all something that happens once in lifetime types. It's a black swan event, doesn't happen every year and every month. It happens once in lifetime. I think the way the market has fallen, naturally it has been converted into buying opportunity in the longer term perspective. I think normally in a bull market, we continue to stay invested and then keep building the portfolio. At the same time, when the market falls, naturally everyone gets fried, therefore they find many reasons why you should not make investment. And then that's, I think, the tough part of every decision making for the investor's point of view, even for money manager's point of view. I must also mention that last few weeks, despite the FIs have been taking out money from India, domestic institutional investors are the largest buyers. Even today as well, the market hit the lower circuit and most of the money managers like us were actually looking for an opportunity. Not, of course, everyone would have got an opportunity to buy at the low bottom of the price. Given the fact the market went open for trading, it of course bounced back as fast as it fell. But having said that, investors, my view is, would come and look at this as an opportunity for building the portfolio for longer term. And we as a fund house also gave a call that one must make this full use of the current fall and build a portfolio, even if it means that you are losing money on the existing portfolio. I think building at the bottom and averaging to, I think, much better way to build the portfolio.
The fear what I see, Mubina, is that the definition of a bull market has become a bear market. And the definition of bear market is prolonged pain for a long time. Right now, economy is having impact on the market, but given that US is a much larger economy, European financial markets are collapsing, there's a financial Armageddon, so to speak, everywhere else. Is it a matter of time that the market fall will start impacting the economy? I hope we are not there, but in case we are there, and in case the financial market collapse starts haunting the real economy, which already is contracting, and financial institutions or central banks do not have the ability to use that muscle power to fix the economy, I really hope we are not in for a long winter. So I think that's really the big concern, that if we are in for a long winter, more like a bear market, then even a SIP will not work.
Yeah, no, true. I think your point is right. I think now it's a question of dilemma in terms of especially oil price drop, the prolonged impact of coronavirus in terms of growth in various sectors would take away the profit for the next 1 or 2 quarters very easily. At least 1 quarter profit can get wiped out. The way I think the inactivity is now surrounding on every country. But having said that, there is an equal amount of pressure is coming on central bankers. Equal amount of pressure is coming on the respective governments to do something. I think what we saw yesterday in US, reacting to $500 billion pumping in. The moment rupee crossed 75, Reserve Bank of India came and started supporting rupee dollar, and that's something which is again quite positive. And today, the finance ministers coming and announcing a few of the restructuring plan for S Bank as quickly as they did the moratorium, at the same speed with which I think announcing the resolution plan. This is something I think they are also quite caring for the economic growth comeback. But having said that, from India point of view, I think the biggest boon that's coming is oil price being at $30, and I think the complete demand supply situation got changed more in favor of keeping the oil price low for a prolonged period of time. If that's going to stay, I think India will become the largest beneficiary of low oil price staying for long, have an impact on currency movement, have an impact on the balance of payment. Therefore, fundamentally, India can get better, provided we get some of our acts right. And that's something which is in the hands of government. Now, whatever the pending structural reforms are there, if they're able to roll out much more quickly, without putting much pressure on the industry at this point of time, whether it is auto industry or any other industries, and give them more time, give them more leg room, at the same time take few actions which can actually shift the whole gear towards India, because we are rightly positioned. I used the word as God's an opportunity from India point of view.
While of course we are expecting some action from the government, from financial institutions, but for our viewers, who have their daily lives to go about, they don't have time to sit and track maybe your everyday NAV values, and I hope they're not sitting and tracking everyday NAVs. And SIP, we usually say an SIP is the best way to invest in the market because you're picking up small bits, right? So even if, let's say, we are in that long winter, wouldn't you still say that now is the time to perhaps even systematically increase your systematic investment plans because you're getting to buy more at a lower price? So, I mean, would you make a case that maybe now is the time to increase the amount of SIP you're putting?
No, only of course SIP is being advocated by most of us as a player to invest in mutual funds, keeping in mind the purpose for which you are coming. But the lump sum investment we don't generally advocate.
Of course.
We don't generally go and actually say, put lump sum money in now, this is the right time to put.
Yeah.
But fortunately, in the last few days, for the way fall has come, we ourselves as a fund house went out in the last 2 days saying that now is the time to put money of lump sum amount as well. And given the fact the market has fallen quite substantially, and there is an irrational behavior that has come in the market, valuations have become cheaper. Today, the earnings yield of companies is higher than the bond yields, with bond yields being at close to about 6.3%. And 10-year government bond yields. So therefore, everything if you look at from a valuation point of view, where you are worried at that point of time, it's becoming more favorable for money managers to invest. So excess has been now removed. So now is the time actually to put lump sum investment in the equity schemes, keeping in mind that I am investing money for 3 or 5 year period. Having said that, even SIP itself, if somebody has done 1,000 rupees SIP, naturally he has to have a step-up SIP. He has to just increase that SIP from 1,000 to 2,000 rupees, subject of course he has an income in his hand.
Yeah.
And as long as you apply both the principles, and then naturally you will be able to build a portfolio at a reasonably good level of the market, which provide an opportunity for investors to invest in mutual funds.
Okay, all right. The other point I wanted to talk to you about is allocation. We have large caps, small caps, mid caps, debt as well. Debt sometimes is that one category that a lot of our viewers conveniently avoid because yields and things like that are something very jargony. It's not something that they usually tend to understand. But again, we are sitting at a situation where people are expecting that, oh look, RBI is going to cut rates. ECB may have not done it, but China has done it. Maybe RBI may cut rates. So they want to act on that as well and say that, okay, maybe I should take some sort of an exposure in debt. While ideally you should have some component of debt in your portfolio, if our viewers do not have that yet, How would you advise they allocate their portfolio to the debt side as well right now?
So the fundamental principle in which one should look at mutual fund. Generally, people think mutual fund means in equity.
Yeah.
Mutual fund means only SAP of investing. We have something more than that, which is right from the liquid funds, which provides an alternate to the savings account, and the entire debt fund, the low duration funds or long duration funds. It actually provides an opportunity for people to play on the interest rate fluctuation. Still look at actually long term investing. And of course, equity is one which is ranging from large cap to the multi cap to the mid cap and the balance fund as a category. I think the way I look at it, every investors have to look at 50% of the money should go towards equity and 50% of the money should go towards the debt funds. So this takes care of your balancing act of your investment. So one of course will give you a supernormal return and also give you a supernormal volatility. But the fixed income is something which will give you a stable return for a long period of time. Of course, return can vary and from time to time basis. But one should always keep in mind that I invest in 6% as well when the rate is 6%. I also invest in 8% when the rate is 8%. So therefore, that takes care of most of the risk that is involved. So if you apply this principle of 50-50 ratio, and then you keep moving up and down depending upon what is the interest rate scenario that is prevailing, and what is the outlook on equity is prevailing, and then keep moving assets from one asset to other assets.
Of course.
As far as the equity is concerned, the way the market has fallen, broad market has fallen. I think earlier there was a feeling the market is driven by 5-6 names. Today everything has become equal. Whether it is mid cap, large cap, nothing has been spared. In this scenario, definitely it makes sense actually to look at large cap names. Large cap fund definitely makes sense to allocate. Multi cap funds, of course, is again supposed to be part of your permanent portfolio. Having said that, somebody doesn't want to take the call of both debt and equity. Naturally, balance advantage fund plays the role of asset allocations. And if you keep in mind which segment in which you want to operate, so you can have pure equity, you have an asset allocation fund where leave the worry to the money manager to decide. At the same time, have some portion of portfolio in fixed income. Especially times like today when we see the equity returns are showing such negative return, you will have some satisfaction coming on fixed income portfolios.
Yeah.
But one of the mistakes that one should not do, and within the fixed income space, most of the people prefer to look at the YTM of the portfolio and then say YTM is 11, therefore it's good fund to invest. Or YTM is 14, therefore it's a good fund to invest. Believe me that if they higher the YTM means higher the risk as well. Therefore keep that in mind. Such kind of funds you use it as only for some portion of the portfolio to allocate in that fund. And rest of it you allocate only to the traditional funds such as large cap, multi cap and balance advantage fund on the equity side, and on the fixed income side, low duration funds, corporate bond fund, or banking and PSU funds or money market fund. Just leave it at that. I think your total allocation of portfolio can be fulfilled. At the same time, return the balance would also be achieved.
Okay.
No, very simple things, Mubina, you got to ask now is that, do you panic? Do you increase the allocation more? Do you worry about what's happening to coronavirus? Or in hindsight, when we will talk about March 2020, this would be like a blip. And again, just to give this equity perspective here for the benefit of our viewers is that in last 75 years and last 100 years, we've seen world wars, we have seen oil embargoes, we have seen assassinations, we've seen floods. Whatever could go wrong to the modern world could go wrong has actually gone wrong. And yet Dow, not our index, yes, Dow has gone from double digit to 5 digit. Sensex from 1980 to now has given a CAGR return of double digit despite the crash. And we know that how India's growth has been uneven and what events have actually hit us and haunted us from 1980.
That was actually going to be my next question, Nikunj, because you've seen 2008, you've seen how mutual funds as well have panned out, but great, I think you've already answered that question, and I think Mr. Bala as well has said that, the last few days have been tough as a money manager, but I suppose never waste a good crisis, am I right? And like you said, I mean, when you look back at March 2020, how are you going to look back at it? Did you just let it go, or did you actually take the opportunity to buy it? So I suppose the word of advice is, use this opportunity to increase your SIP. Nikunj as well as Mr. Bala, really appreciate both of you giving us your time on this episode of The Money Show. Folks, we will take a very short break, but when we return, we will be joined by Dhirendra Kumar of Value Research. Don't go anywhere.